So I want to thank Mark Dalton for joining us today. I know Mark works with a lot of real estate agents and coming up on another tax season. So I want to get him here and to help you guys out with any questions you may have. Um, so I don't think Mark has anything to present as far as a PowerPoint, so he's here for questions. So feel free to ask him any and all of your questions, and I'm going to have some along the way as well. So, Mark, it's all yours, sir.
All right, very good. Thanks for having me. I'm Mark Dalton. I own a small accounting firm here in Kannapolis, Mark Dalton and Company. I think I spoke with many of you guys last year. Can you guys hear me? Something's happening on my end here.
I can hear you, Mark.
Okay, very good. Anyway, we want to talk about a couple things. Of course, real estate agents are sole proprietors or contractors, I guess is a better word. You get your money and you're responsible for paying your own taxes. So the most important thing is tracking your income and tracking your expenses. The income is the easy part. Most of you get a 1099 from your brokerage. The hard part is taking that big chunk of money and reducing it to a smaller chunk of money so that you pay taxes on the smallest amount possible. There's really three types of business entities: the sole proprietor, an LLC, and an S corporation. Most all real estate agents start out as a sole proprietor, and there's huge differences in the taxation between a sole proprietor and an S corporation. There's many tax savings in being an S corporation. We'll talk about those. But basically, a sole proprietor takes his income, subtracts his expenses, and pays basically four kinds of taxes on that income at the end. He pays federal tax, he pays state tax, and he pays FICA tax and Medicare tax on the net earnings. Of course, to get to the net earnings is where you must be diligent about tracking all of your expenses. One of the biggest expenses for a real estate agent I have seen is tracking your mileage. Of course, now there are apps for those things, so it makes it a little bit easier, but I do see that in my experience that lots of times you lose some of that by not tracking your mileage appropriately. The next order of business is an LLC, which is exactly like a sole proprietor from a tax standpoint. It does one thing and one thing only. It's a limited liability company, and it protects your personal assets against a lawsuit in the event of such thing. It does nothing for you from a tax standpoint. An S corporation is the next one, and it is the best way for a real estate agent to go. For an S corporation pays you as an employee, and then the rest of the money is passed through to your individual tax return, and you pay tax on it at the personal level. Where this is important is that pass-through money is not subject to Social Security and Medicare tax. So an easy example, if your net profit was $100,000, an S corporation would pay $15,000 less in income taxes than a sole proprietor. So, I encourage most all real estate agents to, at some point, become an S corporation. The breaking point is really about $25,000 net profit before you really make that jump, because there's some bookkeeping costs that require, that are required. You must have a balance sheet, a profit and loss statement. You must have payroll, make quarterly payroll deposits. So there's some things that you have to do as an S corporation that you don't have to do as a sole prop. New real estate agents have to be doing this for a year before they can become an S corporation. So you can't just hop right into that. So you must be doing it for a year. And of course, you do that by doing a firm. You have to fill out a firm license with the real estate board. I'm going to talk a little bit about taxation. for real estate agents and some of the expenses that you should track. Two things. One big thing happened 2 years ago. Something called QBID, Qualified Business Income Deduction, and that's available to both sole proprietors and S corporations. That's basically a 20% deduction off of your net profit. Deduction is the wrong word. I guess it's an adjustment. So that means if your net profit is $100,000, then you take 20% of that. And there's a calculation. So I'm speaking in generalities. But there's a calculation that says you take that $100,000, you take 20% of that, you reduce that $100,000 by $20,000, and you're paying tax on $80,000. So that came into effect in 2018, was available in 2018, 19, will be available again this year. Depending on tax changes, it could go away. Now this is set to expire in 2025, but it's a substantial tax savings to everybody that has a business. It's called the QBID, and if you're doing your own tax return, I caution you, because that's something that could be easily missed. If you're having your return prepared by somebody that's not doing it at their kitchen table, then you're probably getting that QBID. There's, of course, the obvious expenses, the dues, the advertising, the appraisal fees. Mileage is a big thing with a vehicle. I get asked all the time, is it better to take mileage or actual expenses? Well, vehicles can be tracked two ways. You've got to track the miles regardless. The mileage for this year is 56 cents a mile. So if you're using standard mileage rate, you get 56 cents per mile. If you're using the actual, you can take the cost of the vehicle, repairs, maintenance, tags, tax, vehicle washes. It really depends on the vehicle. If you're in the habit of buying a vehicle every 2 years, you're probably going to take actual expenses, because you get to deduct the cost of that vehicle every 2 years. Lease vehicles, you can deduct the cost of the lease expense and the actual expenses. So that's one of those things. If you've got an older vehicle that you're going to keep for a while, you're probably going to take mileage. Regardless, you've got to track your miles either way. Excuse me. Also get the question about food and entertainment. As of last year, entertainment expenses went away completely. You no longer can deduct the cost of entertainment. You can still deduct the cost of food if it's a business-related meal. If your receipt combines food and entertainment on the same receipt, technically that is a non-deductible expense. The expense needs to be broken out. It's a crazy kind of rule, but that's kind of how that works. Equipment, of course, you can buy things. Some of you buy cameras and computers and printers. Those things you can expense up to over $2 million worth of expenses in the Section 179 of bonus depreciation. I've yet to see a real estate agent spend that much money, but that also includes the cost of the vehicle too. But so those are some of the deductions. A couple things that you want to look out for, of course, is again, I see real estate agents missing that mileage deduction a lot. What we see is they make it up, or they come in here to see me and I say, how's your miles? They say, about 30,000 miles. I had two audits last year with real estate agents that had done just that. They had estimated their miles. And we had a heck of a time proving it, because when the IRS wants to see miles, they not only want to see that mileage log, but they want to see some proof that the vehicle you're using actually has that number of miles. And that could be a repair ticket, that could be the inspection ticket from prior year to the current year. So you just can't have the mileage log. So I encourage you, of course, to use an app, and also to keep those receipts. You can't just say, well, I drove about 30,000 miles. I've also heard real estate agents say, well, my car's 100% business because I put a sign on the side of my door. Doesn't make it 100% business, so you can't deduct all your miles. You can only deduct your business miles.
Hey, Mark.
Yes.
Paula.
Hey, Paul.
I've I'm just gonna just go ahead and admit something. I've never kept up with my miles. I
Right.
don't deduct my miles. Is it absolutely necessary?
If you have if you're taking actual expenses, and if you
Yeah.
don't track your miles, there's no way to determine unless your car's 100% business. If your
Hmm.
car's 100% business, it's going to be, you do track your miles. You've got your miles at when you get your inspection. You've got your miles the next time you have your inspection. If your car's 100% business.
Right.
And of course, if your car's 100% business, you better have something else at home to drive personally.
Okay.
But yeah, you should, you know, in the event of an audit, for example, they would ask you, if you said my car's 100% business, well, let's look at your other vehicle. Do you have another vehicle to drive? Because on the questionnaire, when you answer the questions for your miles, it asks you, is this what's the percentage? Do you have another vehicle to drive? Do you keep accurate records of this? So technically, the answer is you should track your miles, even if it's on January 1 on 100% business. I've got 10,806 miles. On December 31st, I've got 21,617 miles.
Hmm.
Uh, but as far as a log, if it's 100% business, that log is not necessary if it's 100% business. Now, I say all those things. Uh, an aggressive auditor could say to you, that's not sufficient because I want to see where you went and the business purpose of your mileage. Um, a correct mileage log says starting point, ending point, and what you did and what was the purpose. Uh, so, but I've had several real estate audits, and I'm thinking back, and I don't think I've had a single mileage log disallowed. I've had yet to have an auditor go through the entire year. What they want is a sample of, and we've been lucky enough, knock on wood, to pull out a good sample from that we could prove, and had clients, have kept good records of those. So for that brief period of time, but you can have an auditor actually want to look at every single mile. I had an auditor disallow a mailbox one time because we didn't appreciate it because we put it up at the same time we built the house. He disallowed the cost of the mailbox because we expensed it rather than appreciated it. So that's how picky they can get. So yeah, uh, a lot of you probably use your. Does that answer your question, Paula? Sort of.
Well, I'm just confused because I take a total. I do. I have to get a car every 2 years, so I take what is it full
You
deduction
take
or
Section
full,
179 the year you buy it, take full depreciation,
yeah.
and you
So
use it 100%.
yeah, so yeah, I do. So if I say I do that, then I do not have to do my mileage, correct? Because you can't do full depreciation and full mileage, can you?
You cannot.
Okay.
You take actual or standard mileage rate. But the rules, Paul, say if you take actual, they want to see that 100% of your mileage is for business. Now, again, I've never had a client that takes 100% of their mileage and come in with a mileage log. They give me the beginning of the year mileage and the ending of the year mileage. I'm
Okay.
saying that with an aggressive agent, they could say, surely you went to Food Line one time in this car. I think that you would, as long as you had a beginning and ending and you had another vehicle to drive, you would have no problem with that scenario.
Okay.
So
I mean, if I went to Food Line to buy a gift card for my client, that's
yeah,
business.
that's business. That's exactly right. As long as that gift card is less than $25. So, or 25 or less. Uh, yeah, that's, speaking of audits, that is where, when I've been in an audit with a real estate agent, that's where the first place they go is gifts to clients. You're limited to $25 a gift, and anything over that is a non-deductible deduction. That's crazy, but I have seen them reclass that as non-deductible, and they're pretty strict about that. So just know, and I've seen, I've got a real estate agent client now, and she gives out a nice set of $200 knives every time she sells a house. she gets to deduct $25. But that's the rule. Gifts are limited to $25.
Hey, Mark, this is Chris.
Yeah.
Going back to the car expense, is there a specifics on what type of car, weight, or anything like that that you can have that can be deducted?
There, you can, with bonus depreciation, automobile depreciation can get very, very complicated. You've got cars, you've got luxury cars, you've got SUVs. But with bonus depreciation and such, you can pretty much write off the value of any car. Now, if you've got a Maserati, you'll have a little bit of trouble with that. But gross vehicle weight does come into play. But again, with bonus depreciation and Section 179, you'll be able to deduct the entire cost of the vehicle if you choose actual expenses. But if you were just to take regular depreciation, you could be limited by that depreciation by if it's a luxury auto. Explaining automobile deduction when it comes to luxury is make your head spin. So, but Section 179 and bonus, you pretty much can write off the entire vehicle in the first year, as generally speaking.
So if I bought I don't know what I drive now, a brand new Nissan Murano, at January of next year, I could write that off.
You could. Yeah.
For a year or 2 years?
Well, you can Section 179 the entire amount the first year if you needed to.
Oh, okay.
If you chose to write it off over a period of years, then you would take a portion of it every year for 5 years, and therein's where you would get some limitations.
What type of limitations are you?
Dollar amount of limitations. I don't remember what the limitations are and it depends on the weight and the value of the vehicle. They're classified as a luxury vehicle. I'd have to look that up, but
Gotcha.
I don't. Quite frankly, Chris, when people buy, it's like what Paul says. She buys one every 2 years, and most real estate people that put a lot of miles on the car do just that. They buy one every 2 or 3 years, and Section 179 that expense every 2 or 3 years.
Yeah.
Because that's a big expense. If you were in the habit, if you were my client, you came in here and says, I'm buying a car for my business, and my first question would be, how long do you plan on keeping it? And if you said, well, I'm going to keep it for 10 years, I would set you up probably on standard mileage rate rather than actual expenses, because over the long period of time, your SMR may be higher than if we took the actual expenses in the first year. So,
Hey, Mark.
Yeah.
I have a feeling you just need a class with me and Chris, because we're going to dominate this. So, would you consider the better tax deduction of purchasing a car or leasing a car if you know that you are only going to keep it a couple years?
Leasing a car, you get to deduct the cost of the lease every year. Purchasing a car, you can Section 179 that car. The problem with Section 179 a car, and then you trade it in, you've got to recapture some of that. But generally speaking, from a purely tax standpoint, the deduction is going to be higher for purchasing that car. Now, from a standpoint, an economic standpoint, it may not be, because of how much a car depreciates when it rolls off the lot. And with leases, you also could run into excess mileage costs that could really hamper you going forward.
Mm-hmm. So your better tax deduction, if you don't want to pay taxes, you go buy a new car and deduct at least 50% of it the first year.
Exactly. Bonus depreciation the first year, then you take depreciation the second, third, fourth, and fifth year until you sell it, and then you have to recapture some of that if you trade it in. Used to be a trade-in. You did what's called a like-kind exchange. That is gone now. So for example, if you paid $60,000 for a vehicle, and you took $60,000 worth of depreciation in year one, so your basis is zero, and you trade that car in year 3, and they give you $30,000 for it, you've got a $30,000 sale that you have to pay tax on. In prior years, you just reduced the basis of your new vehicle by $30,000. So in this scenario, you would have a gain of $30,000. You have to recapture some of that prior year depreciation. That makes sense.
Yeah, I just don't want to have to pay taxes.
Well, if you do, you're the first one that I've ever.
I would much rather have a car payment than pay the IRS more than I have to.
Sure, and you know, like I said, I have, and I can't tell you that I have more real estate agents that buy vehicles and keep them than sell them. I've got one I can tell you that she buys a new car every 10 years, but she does, she's semi-retires and she doesn't put 35,000 miles on one every year. I've got real estate agents that literally put 35,000 miles on a vehicle every year. Now, not near as much now with the advent of with all the online tools that people have. Maybe they don't drive as much anymore. But if you drive a lot, you're not going to keep a car 5 or 6 or 7 years. You're just not going to do it anymore. You wear it out. So buying a car is a good tax break year end sometimes. But let's just say, Paul, that you bought an Escalade 2 years ago, and you took the whole $95,000 in depreciation already, and now you downsize to a Nissan. Well, you've got a huge gain on the trading of the Escalade, and you bought a $20,000 Nissan. You're gonna be upside down on that.
So basically, you need to stay at the value every 2 years. With the value needs to be the same. It needs to be consistent. You don't need to go down. You can go up, but not down.
Yeah, or you'll be from a tax standpoint. Yeah. Keep in mind, I'm talking from a tax standpoint, not an overall financial picture standpoint.
Mm-hmm.
So.
Okay. Thank you, Mark.
Mark, this is Sherry Argabright. What about, and you may had plans to cover this, but what about any personal care expenses like getting your nails done or your hair done, that kind of thing, or even clothes you might buy that is not necessarily a uniform, especially if it doesn't have our advertising on it. But are any of those expenses deductible?
No, ma'am, that's not deductible. The only time I've ever seen those deductible, and you'll laugh when I say this, the only time, this was a case law I saw, the only time I've ever seen those deductible, the lady was a stripper. She was able to deduct her clothes that she took off as a business expense. But no, none of those are deductible at all. And I've heard, I had someone say, well, I have to look nice for my job. Yeah. If you put your name on it, though, I don't know if you guys can see me, but my name's on about everything I wear. When I go to the gym, if you see me at the gym, my shorts have Mark Dalton and Company on it. That makes it an advertisement. But personal care, getting your nails done, getting your hair done, none of that is deductible. Contrary to what some people will tell you, looking nice is certainly a good thing. When you're trying to sell somebody, it's not what the IRS looks like is for business expenses is necessary and ordinary and necessary is how they classify it. Now they don't define that. It's kind of like when you're an S corporation, you have to take a reasonable salary, but they don't define reasonable salary. So, okay. Any other questions about that? Okay. Let's talk about, of course, one thing I always mention is keeping good records. If you're a sole proprietor, there's no requirement that you keep a separate checking account for your business expenses. There's no requirement. If you're an S corporation, there is a requirement that you do that. But I recommend to my clients that are sole proprietors to keep a separate business account because it keeps everything right there. It makes record keeping easy. Even if you've got a personal credit card that you use for business, don't use that personal credit card for other expenses. You can as a sole proprietor, there's no rules about that. But again, it makes it easy for record keeping purposes. Now, does everybody do that? No. But what we find is that instead of doubling up on expenses, we oftentimes miss expenses because you've got a MasterCard that's mostly business, and then you're somewhere and you use that Discover card and you lose those expenses. So even as a sole prop, I would recommend that you have a business account and that your commission checks go into that business account and that you pay your expenses from that business account. and say, well, I also want to pay my mortgage, and you can, but it's also easier to transfer that mortgage payment or that income into another account. Again, not illegal, but a good idea for record keeping. More people will lose expenses by not keeping good records, and then they have to make up stuff and say, well, I know I spent it, but I just can't find it. Whereas as an S corporation, it is imperative that all income goes into the company and all expenses come out of the company. One of the purposes of an S corporation is to limit your liability. And if you are commingling your funds, then you have opened the door for two things. One, opening yourself up, your personal assets up to risk if something were to happen, not in your favor, a lawsuit or something. And two, the IRS could come in and disqualify your S corporation, then hit you with SE tax, Social Security tax, on everything that you've earned. And that's the whole, that's the primary reason you became an S corporation in the first place, the two primary reasons. So record keeping your business accounts separate, suggestion for sole props, requirement for LLCs and S corporations. One little tip for if any of you have kids that are 17 or under, you can hire your kids and they can make up to $12,000 a year and not pay any tax on it because the standard deduction is 12, actually it's 12.3 I think this year. So if you hired your child to do some work for you, put out signs or do filing or all those things, and if they're under 17, you don't have to give them a W-2 or take out taxes or any of that stuff on them because it's tax-free money. Now, if they're 17 or older, you've got to treat them just like an employee. So that's a good tax savings point. And that up to $12,000 that you pay them comes off of your income, stays in your household, and if they want to, they can put that money into an IRA. You could teach them really young to start saving, putting money into an IRA. So good tax planning tip, especially if you've got kids that want to make some money, that need some money. And it's a good way for you to, instead of just giving them money, teenagers are expensive. You can let them work for you, and money given to your children is not deductible, but they work for it, it becomes deductible. So. Health insurance. If you are not covered by a health insurance plan through your spouse's employer, it is important that you handle your health insurance correctly from a tax standpoint. If you are a sole proprietor, it's just an adjustment to income on the front side of the 1040. If you are an employee of your S corporation, that health insurance has to be run through your payroll, meaning it has to be included in your W-2. It goes in, comes out, comes out. Actually, the way it works is you get two deductions and one addition. Complicated mess, but in order to get full credit for it, you've got to run it through your payroll. So if you're just making your health insurance payment as an S corporation employee and you're just paying and it's not run through your payroll, you don't get that adjustment to income. And if you've got a $12,000 health insurance premium for the year, you've lost that $12,000 adjustment to income. Substantial amount of tax savings if you do it the correct way. Of course, when I always talk about health insurance, I always talk about health insurance HSAs. If you've got a health insurance plan that allows HSAs, try to max out that HSA. Again, it's an adjustment to income. You don't have to use it in the year that you put it in. It can carry over. You can take an HSA and invest it any way you want. I have a client that right now has got $79,000 in the HSA plan. They just haven't had to use it. Couple retirement plans for real estate agents as a sole prop. You can have a set plan you can have an IRA, a traditional IRA, a Roth IRA, depending on your age. I would recommend one or the other. A traditional IRA, of course, is an adjustment to income, reduces your tax liability. A Roth IRA does not. However, the earnings come out completely tax-free when you start taking the money out. If you're the sole shareholder in an S corporation, you can sock away a lot of money, 25% of your wages up to $54,000 a year if you're having a great year, into a SEP. So there's earnings, savings benefits there if you're really making if you have a really good year. With the SEP, you do not have to contribute to it every year. You can, some years you can, some years you don't have to. Let's see, that covers my notes. I was hoping you guys had some specific questions. I always have these conversations with clients, and it's so much information I throw out at you. And some of it requires a whole lot more in-depth. And again, you have to know more details. But has anybody got specific questions about things?
I do.
All right.
So do you have to purchase a vehicle? Like, I think I'm going to need to purchase one this year, right?
Right.
Do I have to do it before January the 1st?
You do.
Oh, well, you need to tell me if I need to purchase one, Mark.
I've got some questions for you.
I guess you'll need to call me when we get off of this line.
Yep.
All right. So so if you do a deduction, if you need one, you need to do it before year end.
Yes, you have to make that deduction prior to beginning of the year. And that also is another tax planning strategy. If you've got money coming to you that you've earned in December, if it's possible not to have your firm not pay you until January, that'll reduce your taxable income in this year. I think we're good in 2020 to 2021. The tax laws change. If they do, 21 to 22 may be a different scenario. We'll deal with that when the time comes, but the tax rates could be higher in 22 than they are in 21. Then that would not be a good tax planning tool then. But so you can delay income. If you've got expenses, even if they're 2021 expenses, you can make those now, get the deduction this year. Of course, I always remind people, if you're itemizing, look at your charities this year. If your property taxes are due, if you've already paid your 2020 property taxes, well, that really won't help because you can limit it to $10,000. I forgot that new rule's in effect. But charities, you can deduct charities. If you're giving non-cash stuff, and make a good list of those things before you give them to them. They don't give you an amount. If it's over $5,000, you got to have an appraisal.
And any office equipment or any advertising, is that 100% tax deductible?
It is. It is. It comes directly off the top. The only thing that is not 100% is meals. And of course, depreciation, if you choose to depreciate over a period of time.
Hey, Mark, you were talking a while ago about up to $54,000, and I forgot what you were talking about.
Yeah, into a SEP. If you can put up to 25% of your net profit into, if you've got for example, Chris, if your company is a single shareholder S corporation, and you had a $450,000 net profit year, you could put up to 25% of that income into a SEP retirement plan. The good news is you have until the due date of your tax return to do that. So that's something that doesn't have to be done by the year end. That's something you don't have to do until the due date of your tax return. So, if you made $430,000 profit last year, you can contribute the maximum amount, $54,000, into a SEP, and substantial tax savings. Now, of course, the money's there. It's your money, but you can't touch it without incurring a penalty until you're 59 and a half. But a good tax planning plan. That's of course, there's IRAs that you can put up to $7,000 in. Anybody can do that if you don't have another retirement plan.
If you did the IRA up to $7,000, how long does it have to stay in the IRA? I mean, I guess eventually you'll have to pay taxes on it, correct?
If it's a traditional IRA, you do not have to take that money out until you're 72 and a half now. There's legislation pending to move that date to 75. But if you put money into a Roth IRA, it has to stay in there 5 years, or you incur a 25% penalty on it on the earnings if you take it out under 5 years. But generally speaking, any retirement money, if you take it out before you're 59 and a half, you pay the tax on it plus an additional 10% federal penalty.
So Mark, going back to the car, you're going to have to just meet me and Paul at a car lot, I guess, before the end of December. You have to purchase a new car before the end of 2020 to get it for your 2021 taxes. Is that what you're saying?
It's your 20 taxes.
2020 tax. Okay. But I can buy it any time in 2021, right? And it'll be prorated based on when I bought it.
Yes. If you buy one for 2021, it will be your 2021. It'll be on the 2021 tax return.
Gotcha. Okay.
It's not going to hurt you this year. I mean, it's not going to help you this year.
Right. If you buy one in January, it won't help you in this year. It won't help you this year. Any expense that you incur in 2020 only helps you in 2020. Anything that you do January 1 expense-wise helps you next year. So Chris, if you went and bought a car January 5th, that's a 2021 expenditure. We're
Gotcha.
off 2021 income.
Okay. But like a new laptop, that would be, I mean, do you have to prove that it's all business?
Laptop is considered a listed property, and you know the IRS's definition of proving it's all business is that you keep a log of when you log in and out. I've never seen anybody do that. Technically, they could make you prove it's all business. I don't see them doing that anymore. I don't think anybody's got anything that's 100% business as far as laptops or phones. My cell phone, of course, I use for personal reasons on occasion, but it's a business phone. It's listed in the business, the company name. But technically, but I've got some clients, they'll say, I got this laptop and it's 80% business. And then we take only 80% of it. That's what they tell me. As the accountant, I'm not going to ask you for that log to see when you logged in and out, because you'd spend all your time logging stuff and then you'd be busted and living under a bridge because you kept up with all the IRS regulations.
Mark, I have a question too.
All right.
So you saying about the bank accounts, keeping either using a separate credit card to specifically for business expenses. If we have a credit card that we're using for the business expenses and we lose a receipt, could we use the statement showing what we purchased?
The official answer is the IRS does not accept credit card statements as proof of purchase. They want to see the receipt, but they will take a photo of the receipt. So if you took a picture of that or a digital copy, they will accept it. But the official answer is that the credit card statement is not official proof of purchase. And in the event of the audit, the IRS could disallow that expense.
Okay, thank you.
Sure.
Does that include bank statements as well, Mark?
It is. And even if, for example, if charitable contributions, if you give somebody $250, any charitable contribution of more than $250 requires a receipt. Even if you've got a canceled check for that canceled check is not good enough if it's more than $250, and certainly not the bank statement. They want to see the receipt. Just a quick story, had a pastor who donated to his own church over $10,000. The IRS came in, I gave him copies of the checks. They literally wanted him to go back and produce the contribution statement from the church, which is, I found kind of odd because he was a pastor and he also produced the statements himself. It's a small church, but they didn't accept the check. They wanted the statement. So All right. What other questions? All right, just a quick thing. You guys will write my email address down. I respond fairly quickly to emails. It's markdalton@ctc.net. If something pops up and you have a quick question, just tell me that you were part of the Lantern group and that you were in on this Zoom meeting. And I've got, like I said, I've got some worksheets that I passed out at the last year's meeting that are realtor deductions and vehicle and travel expense deductions. I can send those to you. Sometimes they're helpful when you're putting your tax return together. Also kind of jogs your memory and helps you. If it doesn't help you this year, it'll help you next year. Things I need to pay attention to when I'm buying. Like a couple, like I said, it's just little cheat sheets. Most of you, my rule of thumb is this: if you think it's business, you take it to your accountant and let him express to you that it is or is not. Now, obviously, there's some things that, I had a client one time bought a bird for his pawn shop, and he insisted it was a watch bird that didn't fly. So,
Mark, real quickly before we go our separate ways here, what about a home office and designated space at your office?
Yeah, home office. It needs to be specific for what you're doing, and the way you calculate that is you need the square footage of the home, the square footage of the office, and say that's 20%. Then you will deduct 20% of the mortgage interest or rent, 20% of the utilities, 20% of the maintenance. You can deduct 100% of all the equipment that you put in that home office. A home office will not allow you to take a loss. So if that home office deduction created a loss on your Schedule C, then that loss is carried forward to next year. So it gets you down to zero and it stops there. Home offices, people used to have this thing, well, if I use a home office, I'm going to get an audit. That's not the case anymore, especially in today's world. I suspect now, if of course, none of you guys are W-2 employees, so it doesn't affect you. So all of you, quite frankly, probably have home offices. If you're an S corporation, the whole story changes a little bit, because then the S corporation needs to rent that office space from you to get the deduction. Because the S corporation is its own entity. It doesn't own the house. You do individually. So if you had a home office, for example, I use myself as an example. I've got a home office at home, and it is used exclusively for work at home. It could be if I actually did work at home. But if I wanted to deduct that expense, Mark Dalton and Company could pay to Mark Dalton $100 a month for that space. I wouldn't pay tax on my end. Mark Dalton wouldn't, because it's such a small amount, and I could get that deduction at the corporate level. So, but it is a good question. A lot of real estate agents, especially ones that have not incorporated yet, use that home office deduction. Right.
Hey, Mark, one more question. Sorry. Is there an amount that you believe an agent should make before they even consider becoming an S corp?
Yes, the net profit should be at least $25,000. Generally speaking, the cost of doing payroll reports, bookkeeping, balance sheets, and things is going to run you around $3,000 to $3,500 a year, and that is kind of the break-even point. If you make $25,000 in profit, that saves you about $3,800 in tax. So you don't want to save $2,000 in tax and pay your accountant $3,500 to save you that amount of money. But I would recommend that no real estate agent works simply as a sole proprietor. They at least need to become an LLC and then make the S election later. But an LLC at least protects your personal assets. And let's use you as an example, Paula. Let's suppose that you are driving your car and you pull up to my office, and instead of hitting the brakes, you hit the gas and run through here and break both my legs. And it's your company car, or it's your personal car. I can sue I can sue you and I can get everything that's remotely attached to you. Your house, your retirement, your investments, I can sue, and all that's open game. But if you're an LLC and you're here on business, then my lawsuit is limited to the assets that the LLC owns. I can't get anything else. I can't sue you for your personal assets. Now, you've got some general liability insurance, but if I've got a really good lawyer, and I say, if I go out and see that Paula's got a lot of stuff, I might want Paula's stuff, and I say, she was really negligent, and I'm going to get that stuff. So you should not, in today's world, you should not operate as a sole proprietor if there's any chance someone could sue you for anything that you could lose. So you got to be careful. Just, an LLC can be converted to an S corporation at any time. An LLC, a single member LLC, you report that the tax return reporting is done just like a Schedule C. It's taxed just like a Schedule C. It does exactly what it says. It limits your liability. That scared you, didn't it? Anything else?
Anybody else got anything for Mark? Very good. Mark, thank you so much. This was a ton of good information.
Yeah, thank you very much.
Very good. And you guys, like I said, hope you wrote my email down. If you've got questions or something specific, I may not be able to answer it without some specific, more specificity, but certainly reach out to me and I'll do my best.
Thank you.
All right.
Thanks, everyone. Appreciate it. And again, this will be up on YouTube probably by the end of the day or sometime tomorrow.
All right. Take care.
Thanks a lot.
Bye-bye.
Bye-bye.